The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Matt Miller. We're kicking you off to the closing bell here in the U.S., and I'm delighted.
I'm thrilled to
be
see
back with you.
It's been a while.
Again, filling in for Romain while he's chilling out in Italy for the Olympics. Let's take a look at what's going on here in terms of the market. Seeing a bounce back on the S&P. You can see now a gain of more than 40 points to 69.75. So just 27 points away from the all-time high that we touched a couple of weeks ago after a drastic downturn last week with a recovery into Friday. The Nasdaq also recovering, now up more than 1%. You'll see that NVIDIA is adding a ton of points to the Nasdaq, and the 10-year yield is coming down. Investors buying treasuries regardless of a story that may have spooked the markets this morning. China advising its banks to stay away from U.S. paper. And nowhere can you see the recovery in commodities better than in silver today, a gain of more than 7% to 83.37, 83.38. Katie?
Well, after last week's rout, like you said, Matt, tech seems to be driving today's action. And even with the index up over the last two sessions, the Nasdaq 100, it's still down over the last six. Last week's turbulence perfectly illustrated by short positions, with Goldman Sachs reporting that hedge funds have added record shorts on U.S. equities due to those AI concerns. But Wall Street's tepid attitude today might be more wait and see than pure concern. Consider that this week's calendar is seemingly chock full of data points, from retail sales tomorrow to that delayed jobs report on Wednesday to Friday's CPI, and a big emphasis particularly on that jobs report, which will include an annual revision to the total jobs count number. And when it comes to earnings, the story is less about tech and more about the consumer. We have companies like Ford, Coca-Cola, McDonald's, Kraft Heinz, all slated to give Wall Street a little more insight into how Americans are spending. Although, Matt, there will be some tech, think Pinterest, Robinhood, Roku, Spotify. There's a lot to look forward to.
Yeah, well, the tech, though, that has led this rally for so long is giving up, or has given up, a lot of its gains. The market gains are broadening out to other companies, and this chart shows that better than almost any other. What you're looking at here is the gain of the equal weighted index over the cap weighted index, and we're seeing the biggest spread there since 2020. So it's been a real rotation, if you will, Katie, into the S&P 493, or the less tech-dominated stocks, less of the hyperscalers pushing us higher and everything else doing more of the heavy lifting.
Well, let's keep the conversation going with Andrew Slimmon. He is Senior Portfolio Manager over at Morgan Stanley Investment Management. Pleased to say he joins us now. Andrew, it's great to see you, and I want to talk about that rotation that we're seeing, because whether you're looking at the equal weight S&P 500, whether you're looking at the small caps, it seems like you are seeing that broadening out. And it's interesting that you have the S&P 500 pretty much at record highs, even though it's been kind of patchy performance when it comes to the Magnificent Seven. So what do you make of the market action so far this year? Do you think that this is sustainable?
Hi, Katie. I think it's wonderful. It means more stocks are participating. I think there's multiple reasons for that. Number one is, so far, Q4 earnings reports have been stellar overall. They've beaten estimates more in the fourth quarter than they beat in the first three quarters of the year, which was still a beat. That's the first reason. Number two is the New York Fed has a probability of recession indicator, and it's really been elevated ever since the Fed began to raise rates in 2022. And that's because the yield curve was flat, but now the yield curve is steepening. And when that happens, the probability of recession comes down, according to New York Fed, and that's when the equated outperforms. So it's consistent with what we've seen in the past. And then thirdly, the very, very large companies, while their revenues and earnings came in strong, their CapEx spend went up, which means their margins are going to be under pressure. And I think that's giving concern to the cap-weighted S&P versus the equal-weighted. So there's many reasons for this broadening out. But overall, I think it puts to bed that commentary by the bears that, narrowness is a bad sign.
Well, I want to wrap what we're seeing in the market performance into some of the points that you made in the notes you sent over to our producers. You say that it's late cycle. It's not necessarily the end of the cycle. What is the distinction there, and how does that translate into these equity markets?
Yeah, I mean, it's fascinating. So usually late cycle gets very bubbly and speculative, like it did in 2021, where it's SPACs and memes and meme stocks. And stocks that lead are ones that aren't necessarily fundamentally driven. They don't have earnings. They have a hope and a prayer. And every time we kind of get that again, where you see these non-profitable tech stocks starting to come alive like they did in the fall last year or they did in January, they get walloped like they did last week, and it washes out that speculation. So I think the biggest risk is we go into a kind of a real blow-off stage, and every time I start to worry about it, the market self-corrects. So I think that's that's a healthy thing, and that's why I don't think we're end of cycle. But what does worry me, Katie, is we have high earnings estimates. So far, they've come through. High GDP outlook. Wall Street's pretty bullish on the year. That's a dangerous concoction that is ripe for some disappointment at some points. Not a reason to run out and sell stocks, but usually returns when expectations are this high, that is consistent with late cycle.
Where do you go to hedge, Andrew? Because for the past few years, people have been going into the growth stocks as value stocks. I mean, the hyperscalers had so much cash and they were a reliable source of earnings, but now they're spending that on massive, like $200 billion a piece CapEx, and they're going out into bond markets to buy tens of billions of dollars to leverage up their balance sheet. So the picture looks a lot different.
100%. And this is why, going back to what Katie said, this is why the 493 is starting to work. There are plenty of other areas where companies reported very good earnings, and I think you take advantage of financials would be one of them, industrials, and they sold off last week as the market rotated into, kind of staples, energy, the normal defensive. So I think, that creates an opportunity, but you're absolutely right. As free cash flow turns negative for some of these very large companies, markets are not going to like that, even though the multiples will come down. I think that is a wait and see for these big guys.
So what do you make of the SaaS apocalypse then, or the idea that, not just in software, that AI can disrupt a lot of business models out there? And a lot of those are companies in the 493.
Yeah, I agree with that. So look, I don't think I'm smart enough, and frankly, I don't think anyone really knows what is the right answer. Is this the low? I can't answer that for you. But what I think you need to do is take a step back and say, what companies are doing well? They're performing well. They're beating numbers, and their multiples are reasonable enough that the shorts can't go out and, kind of sell them off even if they beat. So I think that's, I think there's a place in the portfolio. I wouldn't run out and sell them. But, maybe I'm not brave enough to step in with a big allocation. I just don't think you need to when there's plenty of other areas that are doing quite well outside the tech arena.
All right, Andrew, that's a good place to leave it. Always great to get some time with you. That is Andrew Slimmon, Senior Portfolio Manager over at Morgan Stanley Investment Management. Now, coming up, Cadillac going full throttle with its foray into Formula One. We'll discuss the aggressive push into the sport and what it means for the brand with Cadillac Formula One CEO Dan Towriss.
Then from engines to energy, a closer look at the commodities world, particularly the oil market, with one of the smartest names in the space, Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle.
And then we bring it back to Main Street with a check on the consumer. Michelle Meyer, Chief Economist at the Mastercard Economics Institute, joins us to break down what she's seeing when it comes to spending. All that and more coming up. This is The Close on Bloomberg.
This set of rules is here with us for 5 years, so it's not about the first race or two, it's about the next 5 years. Again, extremely confident we have the right people, we have the right tools, we have the right processes, we have the right partners So I'm very confident extremely confident for our future.
So that was Lawrence Stroll, the billionaire owner of the Aston Martin Aramco F1 team. He sat down with me earlier to talk about his confidence in his team leading the high-stakes motorsports category. But he faces challengers, including General Motors Cadillac, which just unveiled its foray into F1 with a splashy Super Bowl commercial featuring the new livery. And joining us now live on the set is Dan Towriss, the CEO of Cadillac Formula One. And this is a high-stakes league here, Dan. Very cool to see Cadillac GM coming into this sport, especially at the same time as Ford, its crosstown rival, enters the scene. But tell us about what your expectations are now, because you've had testing, if I'm not mistaken, in Barcelona, and you're just about to have testing in Bahrain with your new drivers.
So for us, Barcelona was mostly shakedown, so it's testing a lot of new systems. And everybody's talked about the fact that it's a new chassis, so a new set of regulations, new tires, new power units. But for us, for Cadillac, we're building everything for the first time, the fuel system, just all the pieces on the car. And so a lot of it was just reliability focused. As we go into Bahrain this week, we're very excited to now start to push the limits of the car and to see what we have.
You have incredibly experienced drivers, right?
Yep.
And Valtteri Bottas and Sergio Perez. What did they make of the car? And, what kind of feedback did you get from those superstars?
Well, I think some of their feedback's similar to the other drivers. There's a lot less load under the set of regulations on this car, which just means there's less downforce. The car's going to feel a little slippier to drive. And it's going to be a whole new technique as they figure out how to use this power unit with the electrification piece and the combustion piece, combined. So again, it's a very different car to drive this year, and so everybody's in a big learning curve right now.
And I mean, to that point, to that learning curve, you're a newcomer in this space. I know that you've said previously that you want to be America's team in F1, and I wonder, what you see that looking like if your vision is actualized.
So it's really leaning into a new fan base. If you think about the success that Drive to Survive has had, or F1 the movie, which just crushed every record, it's created a lot of F1 curious fans in the U.S., and that was really the thought behind the Super Bowl commercial. It's a big stage, and we wanted to get to people that don't maybe consume F1 every day. If I want to speak to the diehard motorsport fan, it's very easy to. That media ecosystem is very developed. The Super Bowl let us create a conversation about Cadillac Formula One to people who, like I said, saw the movie, thought it was interesting, and say, wait, this team's going to be on track in 30 days? I need to check this out.
Well, that gets a little bit to what I was wondering, which is why a Super Bowl commercial? I mean, you take a look at some of the numbers. On average, I believe Super Bowl ads were $8 million. We heard some reports that they got to $10 million for 30 seconds. I mean, why was it important to sort of have your debut at the Super Bowl, so to speak?
Yeah, it's really just that big audience. I think it's also just it's this cultural moment in sports. The Super Bowl has become so much, about the ads as much as the game, depending who you talk to. And again, so this let us have that platform to reach the F1 curious, to reach a new fan base for Cadillac Formula One, to say that we're coming. And it lets us kind of put that American spin, this bold American team. I mean, what's more American than showing your first ever livery than at the Super Bowl?
Talk to us about the business of Formula One and really the business of racing, because you've been involved in motorsports for a solid decade now, with Cambridge, with Andretti, now TWG. So how do you make money in this sport?
Well, it starts with growing a fan base, which was job number one with the Super Bowl commercial, building up the fan base, and then taking those metrics and reaching out to sponsors and building up that piece. And so it's you have a marketing machine. I mean, really, when you think about today's modern F1, you've got the team, maybe you have a power unit company. You need to have a media company inside your Formula One team as well, because you're marketing to the world, you're creating content, you're drawing in eyeballs, interest, you're storytelling, you're doing all those things to create commercial value for the team, and that's essential in today's Formula One.
By the way, Checo and Bottas are perfect for that.
They're absolutely
Valtteri
perfect.
is an amazing storyteller in his own right. What was your strategy when you grouped these brands together? Because I see like an American heritage line here through Jim Beam and Tommy Hilfiger, for example.
Yeah, absolutely. I think as we think about what does it mean to be, American, we want to have these iconic American brands, these American originals that really create a foundational pillar in our sponsorship ecosystem. And I mean, Tommy is fantastic, Jim Beam, Cadillac. These are iconic American brands. And so Formula One's a global business, so we're going to want to have non-American brands on the car as well. But we definitely want to have those bona fides set up where we're anchored in these iconic American brands.
What do you make of the sort of win on Sunday, sell on Monday mantra from the 50s and 60s? I mean, GM is getting in a big way back into racing, not just in F1. I went to Le Mans with Mark Royce and crew and watched their hypercar there, which was amazing to see. But they also have, vehicles that nobody else can produce right now. They have a supercharged V8 with a stick and the CT5V Blackwing. So I'm really pumped about their offerings.
Yeah, no, the product line is spectacular. It was actually after one of the F1 board meetings, Cadillac, they brought out every car in the lineup, and we just spent the afternoon driving them. And so the product lineup is so strong, and so there's this upward mobility from a market share standpoint in Cadillac. It's the perfect time to bring Formula One and the Cadillac car brand together.
All right, Dan, great having you here with us. Really appreciate you joining us. Dan Towriss, there, the CEO of Cadillac Formula One. Coming up, it's a no from Novo on those obesity drug copycats. We'll discuss how the drug maker's legal battle with Hims and Hers could impact the competitive weight loss market with Rajesh Kumar, Senior Global Life Sciences and Healthcare Analyst at HSBC. This is The Close on Bloomberg.
All right, it's time now for our top calls. Look at some of the big movers on the back of analyst recommendations. And first up, Oracle. D.A. Davidson upgrading the stock to buy from neutral and maintaining its $180 price target in a bullish call that's tied to OpenAI. The firm writes that OpenAI's revamp to focus more on its core will enable it to meet its obligations to Oracle. And you can see that Oracle shares nearly 10% higher. Next in line, we have Robinhood. Wolf Research predicting a comeback for the name, upgrading it to outperform from pure perform and setting a $125 price target. The firm expects prediction market volumes to offset cracks in Robinhood's crypto business, shares higher by about 6%. And finally, we have Roblox. Roth Capital Partners upgrading the stock to buy from neutral and boosting its price target to $84 from $78 on the back of a strong earnings report. The firm confident in the company's guidance and higher quality games, calling the valuation increasingly attractive. Shares higher by 11%. Those are some of our top calls. And another name we're keeping an eye on, of course, is Novo Nordisk. The drug maker behind the Wegovy weight loss pill says that it will sue Hims and Hers in an effort to curb copycat obesity treatments. Joining us live is Rajesh Kumar, Senior Global Life Sciences and Healthcare Analyst over at HSBC Bank, who covers Novo with a hold rating. So there's a lot to talk about here. Of course, we know that last week was particularly turbulent for Novo, but it seems like with this lawsuit, the announcement that they will sue Hims and Hers, that at least according to the stock market, that's a little bit of a win here, Rajesh.
Good afternoon. I mean, it's a litigation between the two players, so I'm obviously not a lawyer, so I can't comment about the litigation. But what I can say is that, when companies invent drugs and they've got patent protection, and in this case, Novo has got a patent protection around their...
Uh-oh.
Seems like we might have lost Rajesh, who is not a lawyer, but I mean, it's interesting when you think about this lawsuit, just the reaction in shares. It seems like shareholders are excited to see Novo at least fighting back a little bit when it comes to Hims and Hers.
Right, and because for so long, this company had been compounding other companies' drugs, and international law wasn't really that important. They continued to sell them, and it continued to hurt other... Oh, he's back.
He's back. Well, let's go there now. Rajesh, it's great to have you back with us. You were saying, though, while, of course, you're not a lawyer, when it comes to this lawsuit, I mean, Matt and I were just saying, it seems like the market is sort of welcoming the fact that Novo is taking a little bit of a more aggressive stance than maybe they would have in the past under prior leadership.
See, patents are not shields, they are swords. So the companies have to go and protect their intellectual property rights. And, if you got a patented product and you're selling the product in the market, you have to protect your intellectual property. And the FTA has also come and asked a few questions. So this is clearly an evolving situation, but clearly Novo are being very upfront that they will not allow the compounding situation to repeat in the oral market, which, according to a lot of people, is very exciting and next leg of growth.
So, but it doesn't help, no matter what happens with hims and hers, it doesn't help the fact that this company is still down compared to Eli Lilly, like 412%, if I put them on a comp graph together. So how come the inventor of these drugs, you know, the godfather of obesity cures, is losing out to a relative newcomer in Eli Lilly?
Lilly is not a newcomer. They both have been competing for 100 years. The reality is, in this situation, what you do have is a second mover's advantage for Lilly. Lilly saw a lot of pitfalls Novo had. It also has a product which has got better weight loss on the label. It launched with a better price. What we are looking at the moment is, if you look at the next year growth guidance both the companies have given, they have similar pricing pressure in the US from the deal with the US government and the Trump RX deal. But basically, Lilly has guided to about 25% growth at the midpoint of the guidance, and Novo has guided to a 9% decline, right? So the bit we know is what the prices are doing. The bit we don't know, what is the price elasticity of demand, what volume growth comes through.
Right.
And both the companies have a different view on how this world evolves.
And we only have about 30 seconds left, but when it comes to comparing and contrasting Novo and Eli Lilly, it's also important to point out that I believe Eli Lilly has about a decade's worth of patent protection, whereas, you know, you think about some of these patent cliffs that Novo is facing this summer, you think about their business globally, how much of an impact might that have?
The reality is, what happens when semaglutide, Wegovy becomes generic, right? So whilst Lilly might have a longer patent protection, for every player in the market, you know, Novo's ability to reinvent its next generation drugs like CagriSema and amycretin is equally important for the market to continue growth beyond 2032.
Right. All right, Rajesh, really great to get some time with you. That is Rajesh Kumar, Senior Global Life Sciences and Healthcare Analyst at HSBC. Coming up, we're talking commodities with none other than Jeff Currie. This is The Close. It is just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld, and sitting to my right...
I'm sorry, I was looking through the Odd Lots newsletter.
I know, it's pretty good.
Checking out what they've got. Charlie McElligott was this week. And
do you get his notes?
Charlie's?
Yeah.
No.
They're kind of crazy. I really like them.
I feel like he's in a certain, like Dan Zwirn and Charlie are in this certain group of people that are just too smart for regular people to understand in rational conversation.
It's literally all Greek to me.
Yes, it is a lot of Greek.
Yeah. But we should talk about oil and what's going on there, because it's been a really interesting asset to watch. I mean, you think about the supply-demand balance, how that translates through into prices. It's been a really supply-driven market as of the last couple of years, but that might be starting to shift.
Well, exactly, because we've seen oil stick in such tight trading window, and it looks like it may be breaking out to the upside. There seems to be enough geopolitical reason for it, but the fact is, every time I talk to somebody about this, they say the world is awash in oil.
Yes, that has been the persistent narrative. I can think of so many great people to talk to about this, including our next guest.
Speaking of the Odd Lots podcast, Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle. Jeff, you were just with Tracy and Joe in the studio, and you told them the super cycle is just beginning. Does that mean that the oil price is going to break out of this range to the upside, even though there's so much supply, apparently?
I like how you say apparently a lot of supply. I like to say show me the glut. At this point right now, the high frequency data, the last week we showed, substantial draws. They've been telling this oil supply glut story for 18 months now, and it still has not materialized. And whether it's you're looking at the forward curves, and they go, oh, well, it's sitting at oil at sea. Well, a lot of that oil at sea is sanctioned oil that can't be touched. And if you're having to scrape the data to find evidence of this oil supply glut, it's not an oil supply glut. These things hit you over the head like a sledgehammer. I think at this point right now, you had a big short in the market coming at the end of last year. In fact, it got up to 230 million barrels, bigger than the oil supply glut. So this apparently, in expectations of a glut, has had a bigger impact on the market than the actual glut. And now we come into this year, you got risk around Iran, the geopolitical risk, and now we're seeing the unwind of that big short. But I think the key point here is fundamentally, we still have not seen anything other than a cyclical weak patch that we saw, towards the end of last year as that OPEC increase in supply hit the market. But I think the main message I want to leave you with is these markets, whether we're talking oil, metals, all of the old economy is substantially underinvested. You look at oil, the last of the non-OPEC supply surge comes through this year. There's really nothing behind it. We have not seen investment in refineries, copper mines, the rest of it. And that's really at the core of our call for a commodity super cycle. Combine that with policy-driven demand that will likely continue to keep these markets tight. I think there's a lot of upside here.
Now, the one the question I have, at least in the short term, Jeff, is about Donald Trump. I mean, he seems to measure his success on how low the prices at the pump are. And so it would strike me that, if there's this much sanctioned oil on the water, he's going to get the sanctions off to get that oil here quickly if we see the price start to creep higher.
Well, I mean, you look at the draws that you had last week. Clearly, there's the ability to accommodate it. But I think there's a bigger point here is, yes, let's say you have a little bit of a glut out there. Let's say it's 50, 100 million barrels that could be brought in if you got rid of the sanctions immediately, which I think would be really difficult to do, and nobody expects that. It's not going to solve the longer term problem. And what we're seeing in the metals markets, you've got copper, it sold off last week, but we're back above $13,000 a ton again, which is an indication that this market is structurally short. All of these markets are structurally short. They're global in nature. And the fact of the matter is, with all the geopolitical uncertainty, there's a high incentive for consumers around the world to hoard commodities. President Trump just announced his vault. The vault is hoarding metal for the United States. China's been hoarding oil because they're structurally short oil. India, Europe, also structurally short oil. So I think these all got to be factored in, that you have these geopolitical risks that are incentivizing hoarding. At the same time, we haven't invested. And we called this the revenge of the old economy. And it's a rotation out of the new economy, tech or asset light, into the old economy, which is asset heavy. Mm-hmm. Now, to give you some numbers, Nasdaq is down 9%, metals and mining is up 25%, and energy, despite the oil glut, is up 22%. So that swing is over 30%.
Right. Well, Jeff, it's interesting. I'm glad you sort of couch this in what's going on with the broader commodity space, because it does feel like, especially from the start of 2026, that there has been some sort of catalyst, and, you can draw some sort of common denominator there with what's going on across these different commodities into what's going on with the geopolitical landscape. But I wonder how that shifted the investor base. When you think about who's buying gold, when you think about who's buying oil, it's not just commodity investors, people who know the space in and out. I feel like, for better or worse, whatever you want to call them, tourists have also started entering these markets in a big way as well.
But you need an enormous number of tourists. We got to be rotating capital out of the new economy into the old economy. Let's take the hyperscalers. They're investing, hundreds of billions of dollars into data centers that are going to consume power. How do you produce that power? Is with commodities. You need the copper to produce the grid, the transformers. You need natural gas to produce the power in the United States, and then you need other natural resources elsewhere in the world. So that investment today is putting pull on the old economy or asset-heavy sector. In other words, you have these hyperscalers that are used to be asset light, infinitely scalable software-based type companies that are now doing asset-heavy businesses. That gets you a lower multiple. Also, you have the fact that they're running into supply constraints, and that's going to put a pull. So we got to take that capital out of that sector and start investing in asset-heavy industries and commodities. And so you call them tourists, but we need, in fact, I like to point out, we haven't seen tourists, as you say, in these markets really in scale since the period of 2002 to 2012, 2013. Right. 2014 was the last time you had real investment in this space.
Well, Jeff, we only have a minute left, but that's actually exactly where I want to go. The fact that, you think about what we're seeing right now, this new profile of investor coming in. I won't call them tourists anymore, but can you draw a parallel between any other periods of times, given your experience covering commodities? What time period does this most remind you of?
2001, 2, 3, and 4. That was the end of the dot-com boom. We saw massive, that's when we coined the term, the revenge of the gold economy. It swung out of the new economy, which was the internet, and into the old economy. I saw a great comment earlier today. You look at the Super Bowl ads in Super Bowl 2000, they're all, internet-based, and it was all about, pets.com. 10 months later, that rotation happened very violently. What was it last night in the Super Bowl? It was all about AI. We'll see how long this lasts, but I think the key point this time around, those internet guys weren't putting steel in the ground. These AI guys this time around, they're putting steel in the ground, and they're going to hit those constraints, and we'll likely see that rotation.
All right, Jeff. Never enough time. Really appreciate it. What a great conversation. That is Jeff Currie. He is Chief Strategy Officer of Energy Pathways over at Carlyle, talking about the start of a new commodity super cycle, Matt Miller.
And when he talks, people pay attention. I had a number of viewers and Bloomberg clients writing in, Jeff Currie is killing it. And he is quite good. I can't wait to go back and listen to his conversation with Tracy and Joe.
I know, but you want to keep the sound on when you're listening to The Close, because we have some great guests. And coming up, we're going to talk about Kroger is actually picking an outsider. Shares of the grocer are on the move after the company named its first ever external CEO. It's today's Stock of the Hour, and it's up next. This is The Close. All right, it's time now for our Stock of the Hour. Shares of Kroger moving higher after the mega grocery store operator announced it's finally picked a new CEO. Retail veteran Greg Foran will step into the job after ousted CEO Rodney McMullen, who was dismissed all the way back in March. Bloomberg TV markets correspondent Norah Mulinda joins us now. So let's talk through specifically just the stock reaction here. How much of this can we pin to Greg Foran, the man himself, versus Kroger coming out and restarting its guidance?
Well, there's a lot of attention on the fact that Greg Foran is coming in because he used to be former CEO of Walmart, and he made some really transformational changes while he was there. A lot of people think about him as modernizing operations. They are also boosting digital commerce, and these are all things that people feel as though Kroger needs right now, especially because it's lagging against some of its peers when we think about Amazon. I mean, they really dominate the tech space when we think about e-commerce, but also Walmart has scale that Kroger just doesn't have right now. So given the fact that people are really seeing this company, struggling, especially given the fact that the CEO left just back in March, there's been quite a few months of uncertainty. So you're certainly seeing shares rallying on the day based off of the fact that, one, we're getting a sense of confidence in new leadership, but also the fact that it's just a relief after uncertainty.
Yeah, I was kind of wondering what Rodney did wrong, because the stock has still doubled over the past 5 years. It's not like they've had a bad run. It just hasn't been as good as, say, Walmart. Right. So it makes sense that when they bring in somebody at Walmart who is like, I think someone at Walmart called him like the retail king or something, that the stock would absolutely soar based on his hiring.
I mean, yeah, the CEO was there for more than a decade. So to your point, he'd been there for quite some time, and the stock was doing pretty well while he was there. But people are looking for outside voice, a fresh energy, especially given the fact that people are really counting on Kroger to make some of these strategic changes. I mean, we just did see the failed merger of Albertsons. That was really weighing on sentiment when we think about Kroger and its broader strategy. So So a lot of investors and analysts really are just looking toward this new CEO to bring in what he was doing perhaps at Walmart and just bring in a fresh vibe.
Norah Mulinda covers stocks for us here at Bloomberg, and you, like me, Norah, grew up near a Kroger.
We know Kroger.
There is no Kroger here. There is no Walmart here. These stores avoid New York City like the plague.
Yeah, well, I don't live in New York City anymore. I live in Hoboken, and I have to say, in New Jersey, I really am partial to King's. Also, Acme. I spent a lot of time in Acme. I'm sure you guys have heard of it.
You know I love Stu Leonard's.
Yeah, well, the man himself and the store, I assume.
Yes, both. All right, coming up, we take you to the closing bell with Kristina Hooper, Chief Market Strategist at the Man Group. This is The Close on Bloomberg.
What does worry me, Katie, is we have high earnings estimates. So far, they've come through. High GDP outlook. Wall Street's pretty bullish on the year. That's a dangerous concoction that is ripe for some disappointment at some points. Not a reason to run out and sell stocks, but usually returns when expectations are this high, that is consistent with late cycle.
And that was Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management, kicking off the show. Now we have about 10 minutes to the close, and we're hanging on to these gains, Matt Miller.
Yeah, I mean, the gains are not insubstantial, right? 0.5% at 69.68, so we're getting back closer to the 7,000 mark that we crossed a couple of weeks ago before, what happened last week with the SaaS apocalypse, right? And the meltdown of the gold, silver, and Bitcoin trades was just amazing to watch. And really the rotation, I thought, was pretty incredible.
And the snapback on Friday was pretty intense. I mean,
nobody stays until you and Romaine, until the end of the market on a Friday. So
did you see what happened?
Yes, I did.
Higher by 2%.
I looked at it later on my
500.
Bloomberg, on my phone.
As you should.
WEI, and checked out the markets. 1% gain.
Yeah, we 2%.
On the S&P.
Yeah.
Wow.
Pretty amazing. I will say it's interesting to see the non-action in the bond market today, even though we got those scary headlines over the weekend about China, how they're going to treat treasuries. So let's keep the conversation going now with Kristina Hooper. She is Chief Market Strategist over at Man Group. Kristina, great to see you in person.
Great to be here. Thank you.
So where to start? I mean, you think about the volatility that we've seen across asset classes over the past couple of weeks. You think about the S&P 500, really a tough trade last week, and then a face-ripping rally on Friday. Where do you make of where we are right now and what the story is?
Well, I think we are not in a great place, to be quite honest, for U.S. stocks, because valuations are still quite high, and all the drivers of this sell-off have not gone away. Mm-hmm. We have concerns about what a worse Fed would look like, and in particular, what the Fed's balance sheet would look like. And certainly, we heard from the Treasury Secretary over the weekend suggesting that nothing's going to happen anytime soon. But there's still a very real risk that at some point the Fed's balance sheet gets smaller, and we certainly know that could have a negative impact on stocks. We also, of course, have tons of question marks around AI. Who are the winners going to be? Who are the losers going to be? That is not going to be resolved. And again, valuations are quite high. So from my perspective, I think this is a time to be very cautious, to be very well diversified, and to be prepared for other sell-offs.
Right. Well, let's talk a little bit more about Warsh and his views, particularly on the balance sheet. There was an interesting note out from Citigroup today, basically saying that he's going to face a tough time actually shrinking the Fed's portfolio. But I wanted to ask which asset class that is a risk for. You mentioned stocks. Would you say that it's a bigger risk for stocks than it is for, you think about the long end of the Treasury curve, for example?
So I think in the shorter term, it's a bigger risk for stocks, just because we can see a very quick market reaction to even just the suggestion that the balance sheet will get smaller. But having said that, I think there are, a number of asset classes are at risk right now. Certainly, we have a lot of pressure on yields on the long end going higher. And it really starts with Japan, which has in the past been a source of driving up global yields higher. We have now a green light for Sena economics to really take hold in a big way, drive up fiscal deficits, and that is likely to bring out the bond vigilantes. And when bond vigilantes come out, they don't stay necessarily in one country. They spread. And so I do think this is a time where risks are far higher than they've been in the past.
And by the way, this is a global story, right? It's not just that Japan is borrowing. They already have a massive debt to GDP ratio. The Europeans have opened up the floodgates. They need to in order to defend themselves without the help of the United States of America. And we are still running 6 or 7% deficits and looking at 125% debt to GDP. Where does a bondholder go?
Well, so I certainly think that there are opportunities in investment grade and some select opportunities in high yield. And I would say that from my perspective, they're attractive places in Europe for investment grade and high yield. I do want to draw a distinction when we talk about deficits growing. Germany has the ability to increase its deficit. In fact, one could argue that they're being so prudent, overly prudent, has cost the manufacturing sector, has cost their economy some growth over recent years. So it is a time to get more fiscally stimulative, and they have the ability. So I do think markets are going to recognize that and treat them differently than other economies where the fiscal deficits are higher, and also where total debt to GDP is far higher.
By the way, do you like then stocks in Europe as well, or stocks in Germany?
I do.
Because they also outperformed the U.S. Last year, and does that continue?
I do. Yes, I believe they will. So what we have in Europe are two things. We have attractive valuations. Now, valuations are rarely predictive in the short term, but we have a catalyst, and that catalyst is significantly higher spending on not just defense, but infrastructure, and that can typically have a higher multiplier effect than other forms of fiscal stimulus like tax cuts for higher income households. So I do think that's going to be paying off. In fact, we heard Christine Lagarde last week talk about some of the positives they're already seeing in the European economy because of that increased spending. German factory orders, for example, is just one of those data points that we can look to. So I do think there's a lot of potential in Europe, absolutely.
And we only have about a minute left, but let's talk about spending on the part of some of these big tech names. Alphabet coming out with a big bond sale, looking to raise $20 billion in a U.S. bond offering, including the rare sale of 100-year bonds. Does the fact that you have a lot of these big tech firms coming out, tapping the bond markets, does that change how you think about them as equity investments?
So I certainly think it does change how I think about them as equity investments, but it also does make me think about the overall economy and how much AI CapEx will be tolerated, how much more spending will be tolerated in the future. It may become more difficult. If a data center could become obsolete in 15 years, will investors be comfortable with a 100-year bond, for example?
It's a great question, one that we're going to try to answer. Kristina, great to get some time with you.
Thank you.
That is Kristina Hooper. She is Chief Market Strategist over at Man Group. Do you know the last time that a tech name sold a 100-year bond?
No.
It was Motorola. It was in 1997.
Wow.
Yeah. Isn't that crazy?
Yeah. Back when the StarTech was like the must-have phone. It folded up and it clipped onto your belt.
Just amazing. And now where is Motorola?
Well, now actually they make software that a lot of law enforcement and military uses around the world.
I did not know that.
Yeah, you should look at the stock. It's been amazing.
I'm going to do that. You know, we're going to look at a lot of stocks next because we're moving closer to that closing bell with a global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And we're about 2 minutes away from the end of the trading day. Katie Greifeld and Matt Miller here, Romaine Bostic on assignment, here to help take us through the closing bell. It's that global simulcast, joined now by Carol Master and Tim Stenovic. We bring together all of our different audiences across television, radio, and YouTube. And Carol, you take a look at the market reaction today. It's not quite the rally that we saw on Friday, but Pretty dang good.
Yeah, and listen, what we're talking about, maybe another record on the Dow Jones Industrial Average, and not too far off a possible record on the S&P 500. I think 69.78 is what we're looking for. So we'll see. A lot more of a bullish tone. Dig inside the S&P 500, though, kind of an even split when it comes to winners and losers today.
You know, Bitcoin. I'm doing this for Matt Miller.
Why for me?
After last week,
Tim.
Matt used to host the crypto show.
Yeah, but you host it now.
I do. After last week, I was thinking, okay, am I going to go home this weekend and Bitcoin's going to be jumping all over the place? I'm going to have to like keep one eye on the Bloomberg terminal. It kind of just hovered around $70,000 the entire weekend.
Because you were watching it all weekend?
I guess. I don't know.
Matt, Tim did that just for you.
I don't really think that often about Bitcoin anymore unless I'm, trying to figure out the password I lost 10 years ago. It is, to me, amazing that this thing trades even at 70, even at 60, $1,000.
Mike McGlone said it could go down to $10,000.
I believe it. I think it could probably go to zero as well.
Sort of feels like pick a number, and you can make a case for that forecast. And as I heard you say last week, Tim, on Balance of Power, no fundamentals, no cash flows. So who really knows? But let's talk about what we're seeing at the close of this Monday session. The S&P 500, it's going to finish off its session highs, but we're still looking at a gain of about 0.5%. The Nasdaq a little bit better here, higher by about 0.9%. And then you take a look at the Dow Jones Industrial Average, really flat on the day. Can't really glean anything from that.
It's 50,000.
Yeah, all right. Anyway, the Russell 2000 as well, a gain for the little guys. On what was broadly a risk-on day, Carol.
Remember way back when there was a day when people actually cared about the Dow Jones Industrial Average?
I still do. I mean, just because Katie and John Farrow don't care about it doesn't mean we have to all dismiss it as it's the stock market index that more Americans know, maybe more global citizens than any other in the world.
It's price-weighted. It's price-weighted. What does that mean in 2026?
It means that the higher the price of the stock, the more weight it has.
That's ridiculous.
Right. That's right. And I mean, 0% of global citizens know that or care.
Thank you.
Thank you for the explanation.
Thank you, financial Wikipedia. All right, S&P 500. Let's go. Let's get this train back on track.
Okay. Are you looking at the IMAP, Carol?
No, I'm not. I'm going to do the setup for the IMAP. 264 names in the S&P 500 higher, 237 to the downside, 2 unchanged. Is that now to Matt?
Yeah,
yes.
I'm looking at this big pie chart on the screen here, and you'll notice that information technology is the greenest piece of that pie, a gain of 1.6% as NVIDIA does well and carries the day for the S&P. In terms of the losers, you see there healthcare, you see consumer discretion, as well as financials. They've all done poorly with staples.
We actually called a circle, not a pie,
Yeah.
Matt, you can call it whatever you want.
It's not my favorite way to look at the S&P in terms of an industrial group breakdown. I like the GRR better.
Well, I love GRR.
Yeah.
You can do that in the mornings.
I do that on the open. Do we not do like winners and losers here? Do Carol and Tim not pick out winners and losers?
Carol's raring to go.
I'm waiting, baby. All right, so let's go to the number one gainer in the S&P 500 and the Nasdaq 100. We're talking about Levine, up about 13%. Let's be fair. 13% here in today's session, up the most in nearly a year. Citi saying clients are up week over week. They cited some store leads data that suggests the Levine has nearly 6,400 e-commerce clients through February 6th, so that's up about 3% from the prior week. I'm thinking probably two at play here. Barron's was kind of highlighting this. A financial publisher and short seller retracted some of its most explosive claims regarding Levine's alleged connections to transnational crime syndicates.
What?
Capital Watch. I don't know.
What does this company even do? I mean, did they name themselves after a character from Superbad?
The company's platform matches advertisers with mobile app and game publishers. Does that answer the question?
Absolutely. It's a $160 billion company.
I know. Stock down more than 30% year to date. Reports earnings on Wednesday after the close. But anyway, so this Capital Watch apparently came out and did retract some of these explosive claims. So I don't know. There's a lot going on.
They provide end-to-end software and AI solutions. solutions.
Software solutions.
Solutions.
All right, well done, team. Well done. All right, let's go to another name, Oracle. This was a top gainer, too, in the S&P 500. The stock in today's session, you can see higher as much as almost 12% at its highs today, up, though, with about a 9.6% gain at the close. Bernstein cut its price target. Melius downgraded the stock, but everybody focusing on D.A. Davidson, which upgraded the stock to buy from neutral, maintaining the price target from 180. Did it actually? I think it. No, did it maintain? I guess it did from 180. So what's interesting is the analyst note saying the fate of the stock is heavily tied to OpenAI and to a lesser extent TikTok, but those relationships could pay off according to D.A. Davidson. So that one was an outperformer. And then one, I don't know how much you guys were talking about this one, but Tegna rallying after President Donald Trump said a proposed acquisition of the firm by TV broadcaster Nexstar Media Group. I guess he was kind of expressing support for the deal in a post on Truth Social. And so the post said, no, actually, Argita Ranganathan of Bloomberg Intelligence came out and said, with President Trump and FCC Chair Brendan Carr backing Nexstar's Tegna deal, there's a greater likelihood of it closing this year. So Tegna, say that 5 times fast, up about 8.8% in today's session.
Okay, some of the gainers. I got some of the decliners. I want to start with Hims & Hers Health. The shares fell 16% today. They fell as much as 29% earlier in this session. Lowest level going all the way back to October of 2024. This is the worst day at the end of the day since June 23rd for the company. Novo Nordisk said it's suing the company for making knockoffs of its obesity medicines. This even after Hims scrapped plans to sell a copycat version of the Wegovy pill. Hims and Hers in a statement on X said, quote, Novo Nordisk's lawsuit is a blatant attack by a Danish company on millions of Americans who rely on compounded medications for access to personalized care. All right, let's move on to Kyndryl holding shares. This is the enterprise tech IBM spun off back in 2021. A large part of IBM's legacy infrastructure services unit down 55% today. Fell earlier in the session. This was the worst day ever. It was halted on volatility. This after news that Kyndryl CFO David Weichner had left the position. General Counsel Edward Siebold departed the post effective immediately. Vineet Khurana stepped down as senior vice president and global controller of the company and moved in a different role. Third quarter results also missed expectations. The company lowered its full year forecast for adjusted EBITDA and adjusted pre-tax profit. Shares shedding more than half of their market value just today. And finally, Workday falling on the day today. It announced that Anil Busri is returning as CEO, replacing Carl Eschenbach. This after the company shares have plummeted over the past year, down 5% today. Shares are down more than 45% from last year, more than 50% from those 2024 highs. This change effective immediately. Eschenbach is stepping down as a member of the board and staying on as a strategic advisor to Anil Busri.
All right, let's take a look at the Treasury market, what it did today. You might have expected more fireworks given that we got this interesting story overnight that China reportedly is urging its banks to curb U.S. Treasury exposure. But then you take a look at 2-year yields, 5-year yields, 10-year yields down slightly on the day. So no selling in response to this headline.
Nothing matters.
Nothing does.
Keep that in mind. By the way, did you see the Bad Bunny halftime show?
Of course I
don't know why. We've gone the whole day and no one has said anything about this.
I was expecting it to come up in the meeting, but
I thought it would be part of the chat.
Why?
Actually, we've said Bad Bunny already on air.
Well, what'd you guys say? Tell us. What did you think?
Yeah, I actually didn't watch it, so.
What?
Not yet.
I thought it was.
It was on very late. All of this stuff is on very late.
This is in Brooklyn. They drive Priuses and ride bikes instead of watching the Super Bowl, but the rest of us Americans watched it, and I thought it was a pretty good...
In Westchester County.
It was a pretty good show.
I thought it was a great show. It was really entertaining. It was a lot of celebs kind of worked in, and I thought Bad Bunny was great.
Thrilled to see Lady Gaga there. Some people were saying it was a random cameo, but I thought she did a great job. But it was interesting also that the grass was people. It
had
was just
feet.
People in the grass.
It had feet.
Yes. Yeah, you can't have that many carts on the turf.
It's like Katy Perry's like dancing sharks. Remember that?
Yeah.
How could we forget? Tim doesn't remember.
No, because he was in bed.
He was cross-pollinating his wheat germ grass at the time.
Preparing his compost to take out in the morning. That's cool, though, Tim.
Getting the $1 million coffee pot ready.
Are we having fun yet?
That does it.
In the hot tub.
Matt, are you here all week?
In the hot tub in the back.
Just today.
Just out of curiosity.
Yeah, no.
That's it? Just today?
A brief, sweet dream.
All right, Matthew.
Matt, we love
Good to have you there. Always, always. All right, that is a wrap. We love you too, Katie. You guys continue. Take care of that TV thing that's happening over there. Katie and Matt, of course, continuing there on The Close on Bloomberg Television. Tim and I continuing on Bloomberg Business Week Daily right here on radio. We will see you again, same time, same place tomorrow.
And coming up on The Close, it's a big week for eco data with retail sales out tomorrow. A discussion on the consumer up ahead with Michelle Meyer. She is chief economist over at the Mastercard Economics Institute. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Matt Miller. Let's take a look at where the markets closed out the day. It's not as exciting as Friday
No, not even close.
afternoon must have been for you guys. But we're looking at gains nonetheless. 69.65 to round up here, the level on the S&P 500. So we are still about 37 points away from the intraday all-time high. I think 69.84 is the closing high.
I believe you.
The Dow Jones Industrial Average I put here because we eclipsed 50,000. 5,000 I almost said, because I remember Dow 5,000. I remember when 6,000 was on the front page of the Post, and I was at Tucker Anthony over at 666 Fifth Avenue. NYMEX crude rallying up 1 1/3%, getting back up closer to $65 a barrel. And we just talked to Jeff Currie of Carlyle in the last hour. He said he thinks we're at the beginning of a commodities super cycle. And speaking of that, gold trading back over $5,000 a troy ounce, so adding $506 today as investors get back into gold. You saw silver rally even harder. Gold only up 2%. Silver was up 7%.
Maybe we'll be talking about gold 50,000 one day.
Yes.
I don't know if both of us will still be TV.
You'll find it very interesting, and your younger co-anchors will be like, who cares about gold? It's like, price weighted.
I remember. Anyway, let's take a look at some of the day's biggest equity movers here. We start with Hims and Hers. We were talking about this in the simulcast. Total wipeout. Novo coming out with a lawsuit. We're going to keep a close eye on that story this week. I also wanted to highlight Cleveland Cliffs here. They came out with earnings. Adjusted EBITDA, I believe, missed estimates, down 16.4% on the day. And then Oracle, we were talking about that interesting note that we got out of D.A. Davidson a little bit earlier today. Oracle shares rising nearly 9% in response. But our top story this hour, investors bracing for a busy week of economic data, including arguably the two most consequential reports, employment and inflation. Wednesday's payroll report more substantive than usual, including an annual revision to the jobs count. Meanwhile, with Friday's CPI print, economists are looking for more evidence that inflation is on a downward trajectory after previous reports were complicated by a record-long government shutdown. Michelle Meyer, she is chief economist over at the Mastercard Economics Institute, joins us now ahead of the data done. Michelle, it's great to have you with us. So give us your lay of the land as you see it. When it comes to spending in this economy, where is the consumer right now?
So I think we're going to learn a lot when we see tomorrow's retail sales report, although it is still just for December, so it's a bit lagged. But what we certainly saw in our own spending pulse insights is that consumers really showed up this holiday season. So it was very strong spending, not only the start of the season, but also finished on a healthy note. And as we even look into January, we're still seeing further spending momentum. So when we kind of look through the trend on a year-over-year basis, we're running about 5% growth for retail sales ex autos on a spending pulse basis, which is a solid pace of expansion.
And it's interesting, you know, I'm taking a look at some of your notes. You highlight the fact that we had some pretty interesting weather, some big storms, of course. Yeah. How did that come through and impact what we were seeing, especially when it affects groceries, for example?
So that's a big story for January. And of course, we're not going to get the census data for January just yet, but we are actively looking at real-time spending. And it was incredible to see how spending shifted around the blizzards. So the first response is stockpiling. We see it in groceries, fuel, and home improvement. We're able to look at the states that were in the path of the blizzard versus those that were not. For grocery in particular, it was a 60 percentage point increase in the year-over-year rate relative to that control. And then, of course, following the actual snowstorm when it hit and then thereafter, there's a reversal. So what it tells us is that there's an incredible amount of noise that has been pumped into the real-time economic data because of the weather that we're dealing with. And that's going to create even more complication when we're trying to extract the underlying trend.
Michelle, what do you expect from tax refunds? My wife's already figuring out what we're going to get. And I hear, on average, Americans will get 15 to 20% more than they did last year. That's got to turn sentiment around. And of course, they got to spend that money, right?
Yeah, those are great estimates coming from the Tax Foundation that suggest it could be substantially higher for the average household. And that matters for the month of February in particular when those tax refunds hit. And I do think it matters because you do see this as a bit of a surprise. The average household doesn't necessarily expect to have more money coming in. They may have heard the headlines, but they don't necessarily know exactly what's going to hit their bank accounts. So once they see that incremental funds, you do tend to pursue either additional spending or paying down debt or using that, tax refund, the surprise money for something that's a little bit more of a splurge purchase.
Yeah. Katie mentioned the record shutdown that we had last year. It looks like we could have another shutdown now. And in a worst case scenario, that would affect the IRS. But I wonder broadly how that affects consumer sentiment and spending, because, we've never seen it as bad as it was. And I don't know if consumers get used to it or if it really drags them down.
So I think it depends on, when it starts to impact the average consumer. They'll see the headlines, they've seen the headlines, but it will matter when it's impacting your air travel, for example. And that was really tangible in the last record-long government shutdown, is that you saw the TSA respond and travel became hard. And that was a headache for consumers. And it was a concern about their ability to follow through with their vacations, their plans, their family travel. But I think otherwise it's just the typical noise in the headlines that, frankly, a lot of consumers have become somewhat used to.
Yeah, that's the thing. I mean, you think about the U.S. consumer, they've been through a lot over the past couple years. You think about the pandemic and then the stubbornly high inflation coming out of this. And now tariffs, for example, have also been in the headlines a lot. Not that we've necessarily seen that come through in the hard data like we were expecting. Michelle, at a certain point, would you expect some of those tariffs, though, to show up when we take a look at CPI, when we take a look at consumer spending?
So it'd be really, important to look through the CPI report that we get at the end of the week. Really anxious to see that data. But as of now, when you consider the tariff pass-through, I think it's been, really based off of certain categories, measured and pretty slow. So presumably it will continue to show through in the data gradually. And part of it is also a function of how willing, frankly, for certain items consumers are for absorbing those tariffs, in the sense that if they see tariffs are not impacting all of the consumer basket evenly, far from it. So the extent to which prices are increasing as a result of tariffs for one item, they may look to substitute towards another item or another product where they don't see that same type of tariff-related inflation. So because there's relativity in terms of the tariff impact and therefore pricing, it allows for a little bit more flexibility on the part of consumers.
Michelle, I was talking to Rick Reeder on Friday, and he was making a point that if we see a weaker jobs market, that's obviously horrible for people out of a job or who are looking for a job. But most of the spending is done up higher by the wealthier consumers. And you've also got, in terms of the economy, the CapEx from the big companies, and the government is putting a lot of stimulus in. How worried would you be if we started to see unemployment tick up closer to 5%?
Well, I do think the labor market is very, very important, but you have to consider what labor market indicator you're looking at. If you look at just overall non-farm payroll creation, there's a big debate, and I think a good debate out there, of what is the steady state? What is the natural churn or turnover in the labor market? So yes, we're settling on a lower growth rate for jobs, but maybe that's where we should be as an economy right now. And therefore, looking at the unemployment rate or looking at ratios like the number of job openings to job seekers are going to be really really important. And extremely important will be looking at wages, the trend in terms of purchasing power, which informs overall consumer spending. And ultimately, we want, a diverse and broad set of drivers for the overall economy versus just a concentration in one cohort or just one sector. That's what creates sustainable and strong growth.
All right, Michelle, great having you with us on the program. Thank you so much for joining us. Michelle Meyer is the chief economist over at the Mastercard Economics Institute.
Meanwhile, we got some earnings out of On Semi here. Let's quickly run through these numbers. When it comes to the fourth quarter, revenue coming in right with estimates $1.53 billion. Adjusted EPS slightly ahead of expectations at 64 cents. The estimate had been for 62 cents, but shares actually falling in reaction in the after hours. Let's go to the forecast. They see first quarter adjusted EPS between 56 cents to 66 cents. So a 10-cent range there. The estimate had been for 62 cents. When it comes to first quarter revenue, $1.44 billion to $1.45 billion. The estimate was for $1.51 billion there. So clearly investors not really comfortable with those ranges. And you can see shares down about 7% or so, Matt.
All right, On Semiconductor has been one of those stocks that's doing incredibly well in 2025 and the beginning of this year as well. It's down 7% in the aftermarket, but it's had a good year to date. In the last month and week, it's up 20%. It's a $26 billion company.
I have to say, with some of these tech names, the reaction to earnings has been pretty brutal. This feels like a very unforgiving market. And I mean, I know you come in the morning, and sometimes what we see in the after hours completely reverses by the time that you start your show.
Yeah, well, that's why we count on you and Romaine to take us through the close. All right, coming up, Alphabet borrowing far and wide to fund its AI ambitions. We're going to have more on hyperscalers selling bonds next, right here on the close. This is Bloomberg. Alphabet set to raise $20 billion from its U.S. bond offering, exceeding earlier expectations of $15 billion. The offering attracting more than $100 billion of orders, among the strongest ever for a corporate bond offering. Robert Schiffman of Bloomberg Intelligence joins us now. And Robert, this seems to be a little bit of a pattern, right? We had the same thing happen with Oracle last week, where these big, heavy tech companies come out with big bond offerings, and they have a massive amount of demand, regardless of what little we know of the future in terms of turning this AI thing into actual profit.
It's so funny. For the last couple months, all I heard was that there was an AI bubble. And clearly, bondholders are not talking about bubble concerns today. I've never been more bullish on this space than I am today. And I think the rise in CapEx guidance that we saw last week across the board, as well as these massive books, the poster child of everything wrong with AI, Oracle, had a $130 billion order book last week. Alphabet is doing a 100-year bond, a $100 billion order book. There is demand in this space from the bondholder community that's telling everyone on the equity side, calm down, it's going to be okay.
It's pretty amazing to contrast those two stories, because you're right, that is the conversation when it comes to big tech spending, and obviously that bond demand sort of quiets it down a little bit. But the detail that delights me about this Alphabet bond offering is that 100-year bond. Talk me through how I should be thinking about that, because who is buying it, and why would Alphabet want something of that duration?
It's actually a wonderful sign that there's demand for a 100-year bond. We got asked a lot of times today, like, why would anyone buy something for a technology company that we don't know is going to be around in the next 30, 40, or 50 years? The reality is, from the bond math, it's very straightforward. There's really no difference between a 100-year bond and a 30 or 40-year bond from a duration or risk perspective. From an asset manager's perspective, the incremental yield that you're getting actually does mean a lot, particularly in a spread-compressed environment. My guess is there might have been reverse inquiry on that deal. Somebody coming out, an insurance company, saying, we've got long-lived liabilities, we want the long-lived assets.
So how much do you get paid to lend somebody money for 100 years? I mean, when I was a kid, it was like, if I want to lend you for a day, I'll charge you much less than if I want to lend to you for a year, right?
Yeah, well, the coupon on Alphabet's long end for 40-year paper is going to be in and around like 5.6%. So maybe it's 10 basis points less for a 30-year. The 100-year hasn't been priced yet. It's going to be in British pounds. But it's probably not going to be that much more than that. It really is not a matter of cost. It's a matter of financial flexibility.
All right, Robert, wish we had more time with you. Come back soon. That is Robert Schiffman of Bloomberg Intelligence. And coming up on The Close, New York City Comptroller Mark Levine warning of the city's multi-billion-dollar deficit. He joins the program next. This is The Close.
The city's relationship with its wealthiest residents, most profitable corporations, also has to change so that we can bring this city back to firm financial footing. As the mayor, I am legally required to balance the budget of this fiscal year and the next. That is something we are fully going to do. In order to do so, we have to deal with these structural problems.
That was New York City Mayor Zohran Mamdani speaking with Bloomberg just a few weeks ago, warning of the city's $12.6 billion budget gap over the next 2 years. Mark Levine, he is New York City Comptroller. He joins us now on set to discuss. Mark, it's great to see you.
Great to see both of you. Thank you.
So let's start exactly there, the budget gap. I mean, when you take a look at how that possibly could be fixed, is there any hope of fixing that from the revenue side, or is it going to be cutting costs?
Our revenues are pretty good right now, partly because the finance industry is doing so well, but more than that, commercial real estate's doing the best it's been for 20 years. The problem is that we have some expenses that are growing very fast that have not been accounted for in the budget. And when we took a look at the books, what we've seen is a very big gap, which is something we haven't seen in New York City at this scale since the financial crisis. How are we going to solve it? It's going to require help on many fronts. We're going to definitely need to find efficiencies within city government. We're going to need some help from Albany, I hope. I'll be going there Wednesday to plead that case. I think we can get through this, but this is beyond what we have seen in a budget cycle in probably 15 years.
Let's talk about what you're seeing when it comes to cost, because taking a look at some of them, it seems like there's sources that are constantly under budgeted, if you want to call it that. Overtime for uniform officers, for example, comes to mind. But where are you seeing the biggest growth when it comes to that side of the ledger?
Yeah, so we have an equivalent of a Section 8 housing voucher in New York City. It's got a weird acronym. It's called CityFEPS. We're one of the only places in the country that has a local version of this. Great program. Guys, it's growing by 4% a month. And I think your audience understands exponentials. And so it's doubling every 18 months. And we project that it will be over $3 billion next year.
But hang on, I'm back up. Section 8 to me means something different than I'm sure what you're talking about. Because I think of MASH and Corporal Klinger, right? Oh. You're talking about
housing vouchers.
Money that we pay people to afford to be able to live here?
Yeah, this is a voucher you can use to rent housing in a private building, right? So not public housing. You can go to a home you can find throughout New York City. Section 8's a limited supply from the federal government. We have a local version. Great program. It's growing at an astounding pace.
What, we give out more and more, you're saying?
Yes, we've expanded the qualifications. It's designed for people who are in homeless shelters or in danger of homelessness to help them get out of the shelter, exit
Wouldn't we want them to
homelessness.
get out of New York City? I mean, why have, in the most expensive city in America, why are we putting people up here? Why not move them to places that are cheaper to live?
Well, we want them to be New Yorkers. They're part of our city and our community, and they have family ties here and more, and we can do this, but we're not budgeting for it, and it's blown a hole in our budget that is billions of dollars. Reining in or updating programs like that is going to be key to getting out of this hole.
Well, you mentioned, for example, the performance of Wall Street. You think about how well Wall Street did, how well the stock market did over the past year. Would you expect that to shrink the deficit when we get those updated numbers, or are some of the costs that you're talking about that are growing exponentially going to just have that come out in the wash?
Yeah, I think it will. Look, New York City's economy on the whole is doing very well. Also, real estate taxes are producing more revenue than we expected. Sales tax, again, personal income tax. And we do expect to further revise those numbers because the bonus season we had, one Wall Street person told me it's the second best they've seen in their entire career this year. for December of 2025. But even factoring that in, we're going to be left with a hole. And so while we want to keep the economy going, we want to grow New York City's economy. That is the ultimate solution to our budget problems, and I'm going to be a voice for that as comptroller. We have a complete freeze on hiring in New York, in the private sector in New York, in New York City, with the exception of home health care aides. It's all come to a screeching halt over the past year. We've got to get that going as well. So I'm going to be a voice for getting jobs growing again, because it's going to drive tax revenue. That won't be enough. We're also going to have some efficiencies in government and a little help from Albany.
There is the line of thinking out there that Mayor Mamdani might be exaggerating the scope of the budget problems to really make his case for tax hike, which is popular with his base of supporters and then very unpopular with people outside his base. I mean, what do you make of some of that?
Look, we have a real gap, and I'd rather have a mayor who embraces it so we can fix it than a mayor who just tries to keep kicking the can down the road. So I think this is good news. Look, I think that we've got to get our fiscal house in order. I do think we need more help from Albany. Everything needs to be on the table, I would think, potentially including tax increases. But you hear me talk about some other priorities. This is what I'm pushing for. I think this is solvable. I don't use the word crisis. I think this is a challenge that we can solve with smart policy.
I just wonder, even if you agree that pre-K should be free, and in a good, wealthy society, it probably should be. Even if you agree that local transportation should be free, which is, I guess, a nice to have. Even if you want to continue to pass out an ever-growing at 4% a month amount of housing vouchers for people to live here, isn't it, when you're in a budget deficit like this, time to stop just giving away so much money?
Look, we are definitely going to need a little more discipline in New York City's budget. You've heard me talk about one of the programs, and there's many others. That doesn't mean we can't do bold things. And in the case of childcare, I really do think New York City needs. I think every place should have it. The governor put about $1 billion on the table to help us start on that, and we can begin to phase in a program like that. It's going to take several years, just building it out logistically. But this is going to be a tougher budget, and I think we can confront that. Still try to be creative on addressing affordability and more. Look, some of what we need to do is not about the budget. We got to build more housing. We need 500,000 more units in New York City. That's going to require, in part, unleashing private sector development as well. It's not only about what the public sector can do. We need a partnership.
Right, and we also need probably better transportation from outside in so that we don't build all that housing on this tiny island, right? There was just, and has been a court case about building this new tunnel project. Have you thought about just naming Penn Station or the Empire State Building after President Trump and trying to get money like that?
I'm going to be honest, I would take that trade, because we desperately need to invest in this infrastructure. And we could also rename it after this guy's out of office. Whatever it takes, we need regional transportation infrastructure. And every single commuter train stop should have residential density around it. That would also help alleviate the housing affordability crisis within the 5 boroughs of New York City.
Hey, great having you in here.
Thank you.
Mark, thank you so much for spending some time with us. Hope you come back quickly. Mark Levine there, New York City Comptroller.
Meanwhile, let's take a quick look at how markets closed on this day. As discussed, the S&P 500 finishing about 0.5% higher, led in a big way by big tech. The Nasdaq 100 higher by about 0.9%. A quiet day in the Treasury market. You can see the Treasury yield on the 10-year yield just about flat at 4.20. And then silver, a bounce back there. Silver higher by nearly 7%. This is The Close on Bloomberg. Well, the Super Bowl's ripple effects stretch far and wide, including into the business of live events. Our next guest runs an experiences powerhouse called Medium Rare. They're coming off a weekend featuring more than $20 million of events tied to the big game, featuring Shaquille O'Neal, Guy Fieri, and corporate sponsors, including DraftKings. Joining us live, I'm pleased to say, is Adam Richman. He is co-founder and co-CEO of Medium Rare. Adam, great to talk to you. So for those in the audience who aren't familiar necessarily with Medium Rare, with your business model, just socialize that concept to us quickly.
Yeah, look, we saw a huge opportunity around Super Bowl. Super Bowl really feels like the events itself are actually bigger than the game now. And we fought to grab that opportunity by the horns. And, we have 3 events. Friday night, we have Shaq's Funhouse. Saturday night, we have Sports Illustrated The Party. And on Sunday, we have Guy Fieri's Flavortown Tailgate. So we'll attract over 25,000 fans across the weekend and really give them something awesome to do on Super Bowl weekend and celebrate in a really meaningful way.
They do seem like incredibly fun events. I've seen video, never been to one, Adam. But tell us about the business model here. How do you make money? How do the celebrities that are involved make money, or the organizations that you team up with?
Yeah, for us, our business model is really simple. We go 50-50 with Medium Rare, putting up the money and taking the risk, and then splitting it with our partner. So in the case of Shaq's Funhouse, Shaq's our partner. So he's getting 50% of the proceeds all said and done. But the business model for us relies on 3 key things. Number one is sponsorship. We'll actually do over that $11 million in sponsorships, the number one driver of the events, made up by great brands like DraftKings, Anheuser-Busch, Credit One, Spot on, Verizon, Pepsi, and more. And really the sell to them is, hey, look, a 30-second TV spot for the big game cost almost $8 million just for the airtime. For a fraction of that, Medium Rare gives you a brand hundreds of hours of engagement, social amplification, media, and so much more than just doing a TV spot. So that's really the sell in there. The next big, bullet for us when we're looking at these P&Ls is ticket sales. And then third is corporate hospitality. So we have groups ranging to YouTube that are coming in and doing corporate hosting to the tunes of hundreds of thousands of dollars to make sure that their group is set up and has a great time at our events throughout the weekend.
And, well, I'm curious, now that we have the Super Bowl out of the way, which is literally the Super Bowl, I mean, what is next in terms of potential tie-ins there, since it's hard to find something with that sort of reach and cultural resonance?
Yeah, for us, there's no sleep here. We're actually going on to the Super Bowl of racing, and this coming Saturday, we're at the Daytona 500 with the first ever NASCAR official pre-party. We actually partnered with Burt Kreischer, and it's called Burt Kreischer's Full Throttle Festival. We'll have over 20,000 people joining us in Daytona on Saturday. So we go from the Super Bowl of football to the Super Bowl of racing all in the same week.
Dude, that sounds off the hook. How do you recover from an event like that?
A lot of sleep, and I'm very much looking forward to it. This Monday has been rough, needless to say.
Adam, thank you so much for joining us on the day after the Super Bowl. I hope you can get straight back to bed. Adam Richman there, co-founder and co-CEO of Medium Rare. Now, Super Bowl weekend also resets the clock for NFL hopefuls. Our own Romaine Bostick got a chance to speak with Rasheeda Liberty, founder and CEO of Lady Lib Sports and Entertainment, about her transition from corporate leadership to being a sports agent. Here's part of that conversation.
Texas is a hotbed for many of the larger division schools. So you have SEC, you have Big 12, you have some G5 schools there as well. And so when you think about all of those schools that you have in Texas, and Texas is known for football, that was my starting ground. So I began immediately attending athlete agent days, getting to know the players, sometimes getting to know the players at the high school level as well, so that they begin to establish relationships. So when they are ready to pursue going pro, they remember you, they have a relationship with you, and they're comfortable with you. I also took an approach of meeting many trainers, talking to the media, and also talking to some of the scouts in the front offices to say, who's got next, right? Who's coming up next? Who are you looking at? And putting that all together and looking at who's the team captain, who's the guy that has a lot of production, who's actually on track to graduate, because I know he has some level of discipline. There's many aspects that go into choosing the right player, but that is kind of my approach.
You've also been a big advocate for historically black colleges and university athletics, and a couple of your clients, of your early clients, have come out of that space there. What is actually the state of kind of HBCU athletics? I mean, I feel like in the past, we had a few people kind of bubble up out of that space, and then it kind of seemed to fade away. I know in recent years, there's been a little bit more of attention, maybe because of the Deion Sanders effect, but I'm curious as to what your experience has been.
It has really transitioned over the last year. So with the introduction of transfer portal, with the introduction of NIL space and revenue share between schools, what's happened in the HBCU space is they've been able to attract even more or be competitive in the space to attract very strong athletes. They've been able to actually increase their investment, whether it be in their nutrition, their housing, and what they can do to kind of attract those bigger athletes to come over. So each year, we haven't had a power year like 2022. In 2022's draft, there were 4 HBCU players drafted. That was huge for that year. We've had some fall off in the years to come. It's been like onesies and twosies here and there, but the undrafted free agent space is where the action happens. So a lot of the HBCU players may not, quote unquote, get drafted, but they are signed to a team immediately following the draft, and they actually are making the teams. So you have a lot of HBCU players that are in the NFL today. They just didn't get drafted and you didn't hear their name called, but they are actually contributors on the field and receiving an NFL check every single day.
Our thanks to Rasheeda Liberty, founder and CEO of Lady Lib Sports and Entertainment. Coming up, a conversation with Lawrence Stroll, owner of the Aston Martin Aramco F1 team. This is Bloomberg. Ford and Ferrari both reporting earnings tomorrow, providing a fresh read on the state of the auto industry. Earlier today, I spoke with Lawrence Stroll, billionaire owner of the Aston Martin Aramco F1 team, about what's facing automakers in the coming months.
We're very confident. We started a little bit behind our competitors. Adrian only joined us in March. We didn't get our first wind tunnel car into the wind tunnel until April, so slightly behind our competitors. I believe were in their tunnels in January. We have a lot of new partner with Honda, a new power unit. We have a new gearbox we're making for the first time. We have new sustainable fuels with our fantastic partner Aramco and Valvoline for our lubes and our engine and our gearbox. So there's a lot of new. First time in 75-year Formula One history that they're changing the chassis and the power unit simultaneously. So it'll be very exciting, no doubt, and be a lot to learn in the first coming races.
What would be a win for you, or what would be success for you in terms of placement this season? What do you expect to get?
We don't really go in with expectations. We're going to try our best, do the best we can. I'm quite confident with the team we've put together and the partners I've just mentioned that we'll do a great job. You know, this set of rules is here with us for 5 years, so it's not about the first race or two. It's about the next 5 years. Again, extremely confident we have the right people, we have the right tools, we have the right processes, we have the right partners. So I'm very confident extremely confident for our future.
We have seen reporting that Mercedes and Red Bull have found some kind of edge with variable engine compression. It's all very technical. Some have accused them of cheating like animals, I think was a quote I heard. Others have defended them. Christian Horner came to their defense. What do you think about people looking for an edge in the rules ahead of the season?
Listen, you're always looking for an edge in the rules, and you're always looking to find loopholes. That's part of Formula One. I'm not a technical power unit guru to really give an opinion on exactly what they've done, but I will leave it to those who are in the know. Obviously, there's a lot of talk going on between the various power unit teams and the FIA to check the legality of what they've done.
How about your confidence in Adrian Newey? Obviously, everyone's very excited to see what he can do with your team, and other teams have looked with a little bit of wonder and awe at the suspension, for example, that he's been able to create. What do you think are your biggest advantages with him?
You said it. It's having him. He is the GOAT. He is a unicorn. Nobody has a track record like he's had since his times in Formula One, winning 25 world championships. He is unique. There's one Adrian, and I am very blessed that he's my partner and with our team.
That was Lawrence Stroll, owner of the Aston Martin Aramco F1 team. And by the way, you can catch more from the biggest names in the auto industry by checking out my podcast. It's called Hot Pursuit with Hannah Elliott. It's a fantastically popular podcast.
You know, it's been a while since I had a chance to promote your podcast.
Yes.
It's been a minute.
Yes. Well, I'm sure you listen a lot.
Yes.
You know.
Yes.
Because we have incredible guests.
Do you listen to my podcast?
Yeah, Matt Levine.
My other Matt.
Yeah, what's that called?
That's called Money Stuff, the podcast.
Money
It
Stuff.
comes out on Fridays. We don't actually talk to guests. We just talk to each other, which is kind of fun.
Right.
So.
Well, I talk to Hannah Elliott, my co-host, a lot, but we do have Jim Farley. You know, we do have Mark Royce. We do have Frank Steffenwalliser. We do have the most important CEOs in the auto industry.
Right.
By the way, Lawrence Stroll also owns Aston Martin. I keep looking at his. Oh, there's the money stuff.
Good.
I keep looking at Aston Martin stock and thinking, like, it can't go any lower, right? You got to buy now. But here's a chart that I put together. It shows Ford and Ferrari. They're reporting earnings tomorrow, and you can see Aston Martin there at the very bottom. Ford is crushing it, even with a $20 billion write-down. Ferrari is doing really poorly this year because of concerns about the ever more computerized cars that they put out and the dent that they're seeing in their margins. But Aston Martin just keeps going down and to the right.
You can only go down by 100%, though.
I suggested to Lawrence Stroll. So Ferrari these days, not really celebrated for beautiful design anymore. They've got computers at every corner helping the suspension.
Right.
The shifter is like just a little computer mouse now. And they've got screens everywhere. And I suggested to Lawrence Stroll, like, why not be the analog to Ferrari? Why not put 3 pedals in the box, you know, have an actual stick, gauges instead of screens?
It's interesting that they're just now like starting with all computer everything, because I feel like other car makers are maybe moving a little bit away from that. Like they've realized that people like buttons and they like to do things themselves.
Yeah, they like shifting gears.
It's a tactile experience driving a car. You're not driving.
Is that the whole show?
That's unfortunately the whole show. Matt, this was great. Thank you for joining me.
Thanks.
I'll see you.
It's been a pleasure.
Yeah. Well,
I'll see you tomorrow at the Open, 9 o'clock Eastern.
That does it for us on The Close. Balance of Power is up next. Have a great night.